It wasn't so long ago, was it, that everyone was sure the big risk on the horizon was inflation. The Fed was creating so much money to fight recession that it had to be lighting a match to an inflation bombshell down the road. But now what worries people is the D word, deflation, which is the opposite of inflation. It's a cycle of falling prices and contracting growth in the economy. The classic hedge against inflation is a government bond. You know that Uncle Sam will make good his IOUs even in a deflationary downturn. But now the problem is Treasuries yield next to nothing. So unless anything other than a deflationary disaster plays out, bonds could be a train wreck of an investment. So what do you do? Well, here are 3 rules. First, admit you don't know what's going to happen. You're not going to find the guru who will tell you for sure whether you need to worry about inflation or deflation. So own some government bonds through a bond index fund like iShares Barclay Aggregate Bond. That's your deflation hedge. And also own some stock funds like Vanguard Total Stock Market Index, along with commodities like PIMCO Real Return. Together, these 2 are your inflation hedge. Then admit to yourself you're not going to make money on both your inflation and deflation hedge at the same time. One will be a winner, one will be insurance. Second, favor corners of the market that cover you reasonably well in either deflation or inflation without taking too much risk. One bet would be funds made up of high-quality dividend-paying stocks, like T. Rowe Price Equity Income. Rule number 3, don't forget rule number 1, you don't know what's going to happen. Keep diversified, keep rebalancing your portfolio at least every year, and don't let fear of the D word, or the I word for that matter, throw you off your long-term game.